Hello everyone, welcome to your Chapter 5 class. This week we will be discussing business organization, otherwise known as business entities, your balance sheet, your income statement, which are more accounting forms other than anything, and we will discuss the budget very briefly. But let's go ahead and start. Let's go to Chapter 5, page 5. You should see types of business organizations. Now I really want you guys to pay attention because this part of the chapter is very important. At the top of page 5, I want you guys to put the second step of you getting your license. So at the very top of page 5, at the very top where it says types of business organizations, I want you guys to put the second step of getting your license. Now, this step is very unknown to people that are researching on how to get their contractor license. They don't really realize that the licenses are not issued to you under your name. They are issued to the business that you will register. So for those of you that probably have a couple of weeks now, even though we discussed this, way back in chapter 1 very briefly, now we're going to dedicate a big portion of the chapter to this. So I want you guys to put, this is the second step of you getting your license. So if you guys call any of your instructors or you email me directly, hey Luis, I took the course, but I don't know what to do now. It kind of tells me you're not studying, right? So remember, this is the second step of you getting your license. You have to decide what type of entity best fits you. Now, this is the first step that you're really going to make as a business owner. Remember, when you are deciding to get your contractor's license, you are really switching from an employee to an employer. And this decision will affect you for the next couple of years. Because it's not easy to change an entity. I always tell people that tell me, well, what if I start with the solo owner, but within the next couple of weeks, I want to switch over to a corporation? It's not that simple, right? Anytime that there's a change in entity, you have to send another application to the state. You have to wait the processing time. You have to pay the license fee again. You have to buy another bond. So not only is it a waste of money, it's a big waste of time. Right? So that's why I always tell you, really think about how you want to register your business. When it comes to this chapter, it's not clean and cut information. I'm going to give you everything you need to know, but I really need you guys to focus on this part. So remember, guys, the second step of you getting your license is the registration of your business. Really pay attention to the next few steps. And this is the key here. It's not how you understand the information. It's the way the information is written in the law book and in general, right? Sometimes, again, I explain things and you might interpret it in such a way, but remember, guys, don't steer too far away from the law book because the law book tells you pretty much everything you need to know. Apart from that, the notes are very detailed in a sense where, for example, once I start explaining the sole owner, it's not the way how you understood what I said. It's the way the laws are written in the book and in the notes. So, for example, what is the solo ownership? Now, a solo ownership is also known as a sole proprietorship. Sometimes people confuse it with, let's say, a fictitious name or a doing business as. But even if you have a fictitious name or a doing business as, it is normally you are doing your business as a solo owner. Basically, what that means is there's one person that is responsible for everything. But let's go ahead and read that first sentence. Personal ownership, often called sole proprietorship or sole ownership, is the simplest form of business organization and relies primarily on the financial resources available to the individual. The owner has sole responsibility and complete control. As a solo owner, you must obtain all the financing and are personally liable for any claims against the business. So I'm going to give you guys a summary of basically what that means. So remember, a solo ownership, also known as a sole proprietorship, can also be known as the DBA or a fictitious name. Basically, what that means is one person is responsible for everything. One person has all liability. So what does that mean? That means, let's say, for example, you go into debt and you're unable to pay that debt back, or someone sues you and you fall into debt. They can use your personal assets to pay that money back. So when a sole ownership goes bankrupt, the person is also going bankrupt. So when you go register a solo ownership, you go to the city. You go to whatever city you're located in. It can be San Bernardino, it can be LA County, Orange County, San Fernando Valley area, wherever you are at, there's a place where you can register your business. Rule of thumb here, guys, you always want to include the trade that you're applying for in your business name. One of the biggest errors and mistakes that I see is that, let's say, for example, I tell you sole ownership means one person, right? So if it means one person, that means the business that you're registering is Luis's Painting, right? But if you're going to register Luis and Sons Painting, what does that mean? That means more than one person, right? And that still basically tells me that you're not understanding that the solo ownership literally means one person only. Remember, they don't separate you guys from the company. You are the company and the company is you, which means if you go into personal problems, if you have some personal issues, maybe you owe money to taxes or to child support or personal debt, it will affect your company. Let's say any debtor or judge or court can go into your company account if you do fall into that debt. Or the other way around. What happens if your company gets into a situation? If your company gets into a situation, it will affect you personally. They can go into your personal bank account. They can use your personal assets to pay back any debt that is owed. Okay. Now, a solo ownership only requires an EIN number when you start hiring employees. And what I mean by that is one or more employees. So you need to apply for an employer identification number, EIN, as soon as you hire one or more employees. The EIN number is so you can report your company's taxes. But in a solo ownership, it is only needed when you start hiring employees. Now, in a solo ownership, if the owner of the company leaves or dies, the license will be canceled. And normally the company is canceled as well. Because how do you open up a solo owner? You go to the city, you're going to present them your ID or your driver's license, social security number, or the ITIN number. So again, everything falls under your name. So if the owner were to leave the company, let's say they retire or they die, the license will be canceled. I see a lot of people getting confused here in regards to thinking the license will be suspended or you can transfer the license to someone else. No, the license very simply will be canceled, not suspended, not put on hold, not transferred to anybody else. License will be canceled. So what I really want you to take away, the solo owner, it says it's the simplest form of business organization. So why is the solo owner the simplest form of business organization? Because you are the company. The company is you, right? You go to the city, present your ID, social security number, or ITIN number. You are the company. So everything falls on your back. You are 100% liable for any debt, income, and lawsuits. Do not forget that. If for whatever reason business goes south or you get sued or you fall into debt, you as the person will also fall into debt. You as a person are getting sued. They don't separate you from the company. The company is you, right? Unfortunately, within the last year, I've seen a lot of these situations come up due to the coronavirus. Not in construction particularly, but other people that had solo ownerships that come to the school just to try to get a little bit more information in regards to the entities, because obviously we do register solo owners, corporations, things like that. And unfortunately, when it comes to the solo owner, if, for example, you had to close your business down, you were unable to open up your business due to the coronavirus, and you were falling into debt, your social or your ITIN number was tied into that debt. So it's not as easy as saying, well, business didn't work out, let's just close the business. Because if you do that, you're basically, as the person, going bankrupt. And that's an unfortunate reality a lot of people do face. So the solo ownership is cheap. It's easy to register. But there's a reason why it's cheap. And there's a reason why it's easy to register just like that, right? The worst thing you can do is say, I didn't know. Because when you do fall into debt or you do get a lawsuit, it's not as simple as saying, I didn't know. And I'm telling you this because I have a lot of experience dealing with, CSLB fines or not having workers' comp fines. And when you get that fine as a solo owner, for example, and it's tied to your name directly, and you're unable to pay it, and you go bankrupt, that will follow you. So please really think about the solo owner. If you're gonna do it, that's 100% okay, right? You have to choose the entity that's best for you. But what I don't want is you saying you were not informed or that you didn't have the information. Because there's a reason why it's cheap, there's a reason why it's easy, and I want you guys to be 100% informed. Now, I think I hit all the bullet points already in regards to the solo owner. What I do want to say in regards to the partnership, it's basically the solo owner, but there's 2 or more people involved, which means that for it to be a partnership, there has to be at least 2 people. It can be more than 2 people, but it has to be at least 2 people. Now, the partners do share the responsibility in the partnership, and an EIN number is required immediately. This is also part of the CSLB application. So if you are going to register a general partnership, it has to be at least 2 people. The people do share all the responsibility. And apart from that, the EIN number is required immediately. We're going to go ahead and move forward to page 6, where it says limited liability company. Now, I really want you guys to focus on that last page. Sorry, the last paragraph under where it says LLC. Now, pretty much for any other business, I would say LLCs are a great entity. A lot of LLCs are primarily the entity that I do see getting registered more of when we're not talking about construction. Now, when it comes to construction, I don't recommend it because of these reasons. So this is kind of like a clash of information. So if you talk to most accountants, most tax preparers, or people that run businesses, LLCs are a great option. I would say LLCs are great options for any other type of business other than construction. And this paragraph explains why. So don't say, oh, well, we said LLCs are not great entities. They are great entities, just not for construction. And I'll tell you why. Let's go ahead and read it. The Contractor State License Board requires LLCs to post a hefty bond of $100,000 in addition to the standard contractor's bond in order to obtain a license. So remember, if you're going to choose the LLC, now this only applies to LLCs. This does not apply to anything else other than LLCs. You have to purchase a bond of $100,000. Now that doesn't mean you're spending $100,000. It's 3 to 4%. So if you really think about 3 to 4% of $100,000, that's still $3,000 or $4,000, right? So that's per year. So just because you chose an LLC, now you're spending an additional $3,000 to $4,000 just because you chose the LLC. LLCs are also required to have commercial general liability insurance with a minimum of $1 million coverage. Now, CGL normally, liability insurance normally is an option on private works, residential and commercial. So private works are residential and commercial. They're normally an option. But if you choose the LLC as your entity, it is no longer an option. Now, in order to activate your license, you have to purchase this policy. So if you choose the LLC as your entity, you have to purchase a $100,000 bond, and you also have to purchase the liability insurance just to activate your license. If there are more than 5 people listed on the license, you must have an additional $100,000 of CGL insurance for each additional person listed, which means if you have 5 partners and you're going to add 2 more, 7 in total, then that means you have to have 3 liability insurance policies. I don't think it will get to that point, but what I want you to focus on is if you choose the LLC as your entity, you have to have a $100,000 bond, which is going to cost you $3,000 to $4,000 a year. You have to have the liability now just to activate the license. You still need to purchase the $15,000 contractor's bond in order to activate your license. So this is why LLCs are not required, or not recommended, are not recommended for construction. The insurance requirements are just too much. Normally people go with they want the limited liability because they don't want to be responsible, like in the solo owner, right? If they have to bankrupt the business, they don't want to be held personally responsible. If that is the case, register a corporation. But this is the reason why LLCs are not recommended for construction, guys. Apart from this is something else I want to say. Some students, even after they see Chapter 5 a couple of times, they still tell me, I want to register an LLC. And I always circle back to this page. I always ask, did you study Chapter 5, page 6? And if you tell me yes, that you studied the page, I'm going to ask you, what are the requirements of the LLC? Because some are just throwing out entities. Oh, well, I want to do an LLC. Okay, what are the requirements? Don't do that. Again, this is a second step of you getting your license. This is an important business decision. So I want you guys to be fully informed in regards to your entity. So if you're going to choose that LLC, you got to tell me what the requirements are so I know you're fully informed, right? Now, circling back to why people choose that LLC is because they want limited liability. They don't want to be held responsible in the event of bankruptcy or lawsuits. At that point, I do recommend you registering a corporation. Now, the biggest misconception, the biggest mistake I hear in regards to corporation is, oh, I don't want to register a corporation because that's really big, right? Oh, that's like, so I don't have employees. Corporations doesn't mean it's big. And that's failure of education, right? That's the lack of education. A corporation doesn't mean huge. A corporation does not mean big. A corporation simply means it is registered with the state of California and it's a separate legal entity. So let's go ahead in the first paragraph under where it says corporation on page 6. Let's go ahead and highlight that first sentence where it tells you a corporation is a legal entity created by the government. It can make contracts, be held legally liable, and is taxed. Corporations are a separate legal entity that holds the contractor's license. If an officer or stockholder leaves or dies, the corporation will continue to do business. So that paragraph is really important. Let's go ahead and just highlight that entire paragraph in full. The biggest thing with the corporation, the biggest mistake, oh, it's really big, or I have to have partners, or I have to have employees. No, a corporation simply means it's a separate legal entity. They separate you, the contractor, from the company, which means if you go into personal problems, you don't pay your taxes, you have child support, you go into debt, it will not affect your company. It will not affect your corporation because it's separate. They're separating you from the company. So your personal problems are your personal problems. Now, in the corporation, if the corporation will go into problems, it does not affect you personally because it is a separate legal entity. Okay? So for those people that have assets, that have other businesses, that have properties, that want to protect everything that they've already grown, a corporation is a really great option because they separate you from the company. Or for those people that don't want to be held responsible in the event that the business can go bankrupt, or in the event that an issue can present itself in the future, because nobody knows what can happen. But you want to be well protected and well informed. So a corporation does separate you from the business. You are your own personal person, and the corporation, it's its own business. Now, apart from that, there's a reason why they separate you from the company, because it does protect your personal assets. You will be protected. So your personal assets are your personal assets. In the event of a lawsuit or bankruptcy, they will not be up for grabs. The corporation separates you. The corporation is its own separate entity. Now, partners in a corporation do not pay workers' comp. So this is where it's recommended. If you work with someone every single day, it can be a family member or a friend. If you guys want to be partners legally, on paper, real partners, that is an option. So I do see like when you start hiring employees, maybe you don't really have employees, but it's that 1 or 2 people that you work with every day that you guys are trying to build a business together. A corporation is a great option because you can exempt yourselves from workers' comp. We help you out with that paperwork here. We do what is called the workers' comp exemption forms. We fill all those out for you just to make sure that there's no errors on it, there's no liability on it, to where your workers' comp, to where you don't have to purchase workers' comp at all for partners, registered partners in the business. Now, if you're a roofer, for example, if you're a C39 roofer, you need workers' comp no matter what. But for anybody else, electricians, painters, general construction, framing, painting, tile, if you're gonna work every single day with someone, can be a family member, friend, multiple people, and you guys are doing business together as partners, a corporation is a great option because it'll exempt yourself from the workers' comp requirement. So remember, above all else, a corporation is a separate legal entity. It does protect your personal assets. Partners do not have to pay workers' comp. Right now, the corporate tax rate is as low as it's ever been, 21% on just the profits, which is very, very low. I'm also going to do a separate video on the entities, just to give you guys a little bit more information on how it applies to everyday business. But I really want you guys to think that it is a myth and a lie that corporations pay more in taxes. That is not true at all. Corporations actually pay less in taxes, especially right now. Now, what I do want to say is this. When you talk to tax preparers or accountants, make sure that they are corporate tax preparers or corporate accountants, because you want to make sure that they're not trying to go the easy route with the solo owner. Solo owner is very easy to calculate your taxes. Self-employment tax is 15.3%, and then plus whatever you made on top of that. So in a lot of cases, solo ownerships are paying upwards of 25% in tax, depending on how much money you make. Because ultimately, it depends on how much money you make. But when we're talking about corporations, if you talk to 10 accountants, 5 will tell you the C Corp is the way to go. Another 5 will tell you the S Corp is the way to go. Me personally, for my dad's tree service business, the one that we currently have running, we have a C Corporation. The reason for that is because back in the day when I was 18, 19 years old, I was always trying to get a check back from the IRS, and I went to different tax preparers and I was listening to what they were telling me. They were telling me, oh, you went to school, huh? Oh, you went this, right? They were just trying to add all these like deductions, all these expenses to where I was getting money back from the IRS. And then ultimately what ended up happening is when I turned 21, I got a letter from the IRS telling me that I had been audited. And unfortunately, all that time I was getting money back from the IRS, I had to pay all that money back to the IRS, and we're talking about thousands of dollars here. So your main goal shouldn't be to get money back from the IRS. You have to think about it like this. You are a business. What is the point of a business? The point of a business is to make money. So if you're trying to get money back from the IRS as a business, you're doing something wrong. Your main objective should be reducing your tax bill or not paying the IRS anything in taxes. But if you're getting money back from the IRS, you're still stuck in that employee mentality. Now, your first 3 to 5 years in business, yes, we're talking about you're gonna have a lot of losses because you're reinvesting a lot of money back into the business, and that makes sense. So you have to switch from the mentality from employee to employer. The point of a business is to make money. Please do not try to get money back from the IRS with any entity. With a solo owner, if you're getting money back from the IRS, you're doing something wrong, right? The point of a business is to make money. So again, if you talk to 10 accountants, 5 accountants will tell you the C Corp is the best way to go. 5 will tell you the S Corp is the way to go. The reason why I have a C Corp is because, like that story I just told you, I was getting audited a lot. So my accountant ultimately told me, let's just separate you entirely. Let's separate you entirely from your business. I was making my personal income tax and I was paying the corporation taxes as well. But the biggest thing is reducing your tax bill, Guys, in a corporation, I'm telling you this right now, in a corporation, if done correctly, you can pretty much expense whatever you want, if done correctly. Now, I'm talking about your gas bill, for example. From the time that you drive to your first project, that tax, that gas that you're spending driving to your first project, that is a tax deductible. Okay, if you're taking clients out to restaurants or for entertainment purposes, especially right now, 2021, they repassed that law. That is a tax deductible. Okay, in some cases, when you have a team meeting, those safety meetings once every 10 days that you have to have, you're buying coffee and donuts for your employees. That is a tax deductible. If you're buying yourself suits or like, let's say the business shirts, that is a tax deductible. Everything that you pay for workers' comp, that is a tax deductible. Insurances, tax deductible. Trucks, you want to buy yourself a new truck or new tools, new machines, that is a tax deductible. Do the paperwork. Take the time. We're not talking about not paying taxes. We have to pay taxes, but the best thing is to reduce your tax bill. And I guarantee you, for all those people that were like, oh, you have to pay so much in taxes, they're 100% wrong. Trust me on that. They're 100% wrong. Everybody with the license that has gotten their license, as far as students goes, after they took the course and they talk to an accountant and they really, really start to pay attention to the numbers, they're making so much more money than they ever been. And you know, those same negative people that were like, no, don't get your license because of this and that and that, they're still stuck in the same position. They're still stuck in the same position. And now our students, my students, are making so much money that they never thought they were going to make with the license, because they realized the negative people are going to be negative no matter what. They're going to pay attention to the numbers, because this is what it's all about, paying attention to the numbers, right? So what do I want you to take away from the C Corporation? C Corporation is just a regular corporation. What I do want to say is that highlight the last sentence where it says double taxation is an issue with C Corps, since profits are taxed at the corporate level and taxed a second time at the personal level as dividends. So I do want you to associate double taxation with C corporations. Now, S corporations on page 7, S corporations, the third sentence, you want to highlight that as well. It says this allows S corps to avoid double taxation on the corporate income. Again, talk to your accountant. 5 will say the C corp is the way to go. 5 will say the S corp is the way to go. They both protect your personal assets. They are both great corporations. They are both taxed at 21% on the profits only. So if there is profits, 21% on the profits only. Corporation is the way to go if you want to protect your personal assets. Definitely do recommend the corporation. Now, at the bottom of page 7, it says changing business entity, sole ownership to a corporation. Frequently, contractors will begin as a sole ownership and later form a corporation. Highlight that first sentence on there. Now, what they don't tell you, what the CSLB doesn't tell you is, yeah, if you start as a sole owner, you're going to get a license number. And unfortunately, if you change from the solo owner to a corporation, you're changing entity, which means not only do you have to purchase another bond, not only do you have to send another application to the state, $330, you're going to change your license number. If you change your license number, any business cards that you've done, advertisements that you have done, you're going to have to change all that because you're changing entities now. When there's a change of entity, your license number will also change, right? So if you know you're going to do the corporation, just do it, because I don't want you spending more money. You're basically paying a double application fee, a double bond fee, a double license fee. For what? If you know you're going to do the corporation, just do it. I don't want you spending any more money than you already have to. Then we're going to move forward to page 9, chapter 5, page 9, where it says federal income tax. I do want you to highlight that very first sentence where it says you must get an employer identification number, EIN, from the U.S. Internal Revenue Service before you hire your first employee. Now, corporations, LLCs, partnerships, they have to have EIN numbers. The only one that doesn't have to have an EIN number is a solo owner with 0 employees. I'm going to say that again. Number 1, what is the EIN? The EIN is to report your company's taxes. The only entity that doesn't need an EIN is a solo owner with 0 employees. Once they hire 1 or more employees, they need to have an EIN number. Corporations, partnerships, LLCs, they already have to have an EIN no matter what. Moving on to page 10. Now on page 10, where it says state sales and use tax, in that very first paragraph, I do want you to highlight those three sentences in full, please. Let's go ahead and read it. Many contractors overlook sales and use tax. Sales and use tax is reported to the State Board of Equalization. How often you pay depends on your expected amount of taxable sales in a given time period. So what I really want you to focus on here is that at the state, they might not say sales tax, because that's basically how a lot of people know this tax, as sales tax, but they will give you use tax. So what do we have to know in regards to use tax? Who do we deposit it to? We're going to deposit use tax to the State Board of Equalization. How often you pay depends on an expected amount of taxable sales in a given time period, which is basically saying it's an estimate. It's an estimate your first year. So what I really want you to focus on is sales tax is use tax. So make the correlation. Sales tax is use tax. Who do you deposit it to? You're going to deposit it to the State Board of Equalization. How often do you pay depends on the expected amount of taxable sales. It is an estimation. And then we're going to move forward to page 13. So we're going to be on chapter 5, page 13. Next, number 3, where it says Commercial General Liability Insurance, CGL. So let's go ahead and highlight this paragraph in full. Now, one thing I do want you guys to realize is in order to obtain these insurances, you do have to have a license. I know sometimes we want to jump the gun. Sometimes we start worrying about contracts and we start worrying about insurances and employees and hiring them and how we can get bigger projects. And I always tell people, let's settle down a bit. Let's just really focus on the main thing. So the main thing is you getting your license first, because in order for you to qualify for bigger projects, in order for you to qualify to get these insurances, you do have to have the license. Now, I always tell people again, the license is not the end. That doesn't mean you won. The license is just the beginning to starting your own project. So once you do grow your company a little bit, once you do get a couple projects under your belt, you might want to inquire about these insurances. Now, the commercial general liability, there's 2 situations where you absolutely require the insurance by law. So what are those 2 situations? Number 1, you registered an LLC. The liability insurance is no longer an option. It is required by law now because you registered the LLC. Number 2, if you're working on public works, you need this insurance. There's no longer an option. You need to have it. So let's go ahead and read this paragraph. This is the silver bullet for protecting you, your business, and your employees from any damage incurred as a result of bodily injury, property damage, medical expenses, libel, slander, the cost of defending lawsuits, and settlement bonds or judgments required during an appeal procedure. CGL insurance is often sold as a catch-all and includes numerous add-ons that you can tailor to your business and its degree of risk. For example, if non-paying clients are a concern, you can add accounts receivable protection to your policy. It is also worth noting that oftentimes a client will request evidence of your certificate of CGL insurance before doing business with you. So commercial general liability insurance is an option on private work. So what is private works? Residential and commercial, which means if you don't have an LLC, if you're not working on public projects, this insurance is not mandated by law. It is an option on residential and commercial works. Now, if the client requests this insurance from you and you want the project, then of course you have to get it. But no one is going to fine you. The CSLB will not fine you for not having this insurance. The EDD will not fine you for not having this insurance, right? Again, CGL option on private works, which is residential and commercial. Obviously, if the client requests it, you need to get it. But on public works, it is mandated. And if you have an LLC, it is mandated by law. Now, an add-on would be an umbrella policy. So let's say, for example, you're working at night or you're working under extreme weather conditions. Most standard CGL insurances will not cover you working at night or under extreme weather. But if you really think about it, what's extreme weather? One can say that when it's sprinkling outside, when it's raining, that can be considered extreme weather. And if you get in an accident, they might try not to cover you. So remember, guys, insurance companies, what do? They send an investigator to find a way to not cover you. So be really careful, guys. As far as the umbrella, well, you have to think about it like this. You open an umbrella, what does it do? It pretty much covers you everything. So if you are going to be working at night and you know you're going to be working while it's raining, you definitely want to do umbrella policies. Now, I say raining, but it's pretty much any type of weather, whether it be really windy, whether it be snowing, hailing. I'm just saying it's not usual weather conditions, right? As far as umbrella policy, it increases your coverage limits and expands coverage for things your existing general policy may not cover. For example, if your CGL policy does not cover working in the dark and had a limit of 1 million, an umbrella policy can be purchased to cover working in the dark and raising your limit to 2 million. So umbrella policy, you want to add it when there's high risk situations. Go ahead and write that down. Write it next to this paragraph. You want to add it when it's high risk situations. Not only does it increase your coverage limit from 1 million to 2 million, you want to have this extra add-on when you're currently or constantly in high risk situations. Now, workers' compensation, we did cover that in chapter 4, but it's very easy. Workers' comp is required when you have one or more employees, and it's used when an employee gets injured. Okay, workers' comp, again, we talked about that a lot in chapter 4. It is used when an employee gets injured or suffers an illness due to the work that they do. So for example, if they came in contact with a hazardous substance and they got really sick because of that, workers' comp will cover them. We're going to go ahead and move on to page 14, chapter 5, page 14. I do want you guys to highlight number 1 and number 2 in full. And I want you guys to know the difference between number 1 and number 2. So number 1, the occurrence policy. Let's go ahead and read it. An occurrence policy protects the contractor from any incident that occurs during the policy period, regardless of when a claim is filed. Number 2, claims made. A claims made policy provides coverage of claims only when the incident and the claim happen during the policy period. So really, the difference between number 1 and number 2 depends on when the claim is filed. So for example, number 1, as long as the accident or the incident occurred while you were insured, it doesn't really matter when you submit the claim. They will still cover you. Number 2, the accident or the incident had to occur while your policy was active, and you have to submit the claim still while your policy is active. Because if your policy expires and you never submitted the claim, or you haven't submitted the claim, they will deny you coverage. So that's the difference between number 1 and number 2. It really kind of depends on when the claim is submitted. So number 1, as long as the incident or the accident occurred while your policy was active, even if your policy expires, they'll still cover you, even if you submitted your claim after your policy expired. But number 2, the accident or the incident had to occur while your policy was active, and you had to submit the claim still while your policy was active. If your policy expires, they will deny you coverage. Now, where it says buying a policy, shop around, that second paragraph, you want to highlight those 2 sentences where it tells you, when shopping for insurance, you should obtain several quotes. The best way to choose among different companies is to compare cost and coverage. Anytime we're really purchasing insurance, you don't want to go with your first option. You definitely want to compare at least 3 different companies. And the reason for this is just to make sure you're getting the best price, the best bang for your buck. So number 1, talk to one company, compare what they're charging you compared to what they're covering you. Talk to 2 more companies, find the best average and the most coverage. You're comparing cost and coverage. And in the last paragraph on page 14, you want to highlight that paragraph in full where it tells you, policies are typically extended for a 1-year period of time. You should begin getting quotes at least 3 months before your policy expires. The best way to minimize insurance costs without increasing risk is to compare premiums and coverage annually. You buy a policy for a year, 3 months before your policy expires. Again, talk to different companies. See if you can find the same coverage for less cost. But you don't want to buy another policy with less coverage for less cost. That's not what it's telling you. 3 months before your policy expires, find a company with the same coverage but at less cost. And then we're going to move forward to page 18 and 19. Chapter 5, page 18 and 19. So here's the thing. We're not here to be accountants, right? So there's going to be certain parts of this chapter where I'm telling you, really focus on these terms and these definitions. So I don't want you to stress out about this chapter too much. The number one error or mistake that I see some new students make is that they get to chapter 5 or chapter 6 and they're focusing their attention on the wrong things. I don't want you to get too distracted with things that are not in the state exam, because ultimately we are not here to be accountants. We are here to obtain our license to have our own contracting business, and then obviously we're going to hire an accountant or a tax preparer to help us out with this information. Because if you're trying to do it all, if you're trying to be an accountant, a tax preparer, and then you're still trying to do advertising and marketing, it's just going to be too much and it's too overwhelming. So I don't want you to focus your attention on things that will not be on the state exam. I'm literally going to tell you what to focus your attention on. So on page 18 and 19, there's only a couple things I want you to focus on. Number one, the two forms of accounting, the cash basis and the accrual basis. What is the cash basis of accounting? The cash basis of accounting is not recommended for contractors. Okay, so that's what I want you to know about the cash basis of accounting. It is not recommended for contractors. Do not confuse it with you're getting paid cash. That's not what that means. It's just the system of which you input your transactions in your accounting book. Now, did I lose you there? Probably did. But like I said, do not focus on things that will not be on the state exam. What I want you to know in regards to the cash basis of accounting is it is not recommended for contractors. Please do not make the mistake to think that means you're only getting paid in cash. That's not what that means. Do not confuse yourself. Now, in regards to the cash basis of accounting, a transaction is recorded or posted when the cash changes hands. The accrual basis of accounting is recommended for contractors. That's what I want you guys to focus on. If I provide any more additional information, I'm only going to confuse you more. And like I said, I don't want you to focus things that will not be on the state exam. This is what you need to know. This is what you need to keep repeating to ensure that you've done your due diligence on page 18 and 19. Focus on those 4 points that I just put on your screen. All right, guys, now we're going to move forward to page 20. Now, on page 20, at the very top of page 20, I do want you guys to put balance sheet. So at the very top of page 20 and 21, let's go ahead and put balance sheet. So balance sheet, this is what we're discussing. Number one term I want you to focus on, accounts receivable. So what is accounts receivable? And I want you guys to use my definition. Money your clients owe you, your progress payment. Any payments that are coming into your company will be known as accounts receivable. So for example, if you're sending bills to your clients once a month or once every 2 weeks, the money that your clients are paying you, that is filed under accounts receivable. At the very top of page 21, again, at the top of page 21, put balance sheet. We are still discussing the balance sheet. Again, under where it says accounts payable, I want you to use my definition. Accounts payable is money you owe to your subs and your suppliers. Again, I'm going to repeat that. Money you owe to your subs and your suppliers. So accounts receivable, that's money coming in. Accounts payable, that's money going out. Now, where it says balance sheet, I do want you guys to highlight the first, and let's go ahead and highlight the third sentence, and let's read it. The balance sheet is a snapshot of your business at a specific point in time. It outlines the financial position of your business at a specific point in time by showing the assets, liabilities, and owner's equity. So rule of thumb, something I really want you to focus on. If the question is anything in regards to assets, liabilities, or owner's equity, you know they're referring to the balance sheet. Now, we do have to discuss what a current asset is. So next to number 1, where it says current asset, let's go ahead and highlight that first sentence. It says, in accounting terms, current assets are cash or other assets that can be converted into cash within 1 year. So if you use my definition, it's very similar. Assets that will convert into cash within 1 year. Now, where it says fixed assets, I want you to highlight that sentence as well. Fixed assets are also known as long-term assets, are property and equipment owned by your business, things not normally intended for sale and that are used repeatedly, such as buildings and equipment. Well, I'm going to give you guys an example of that in the next page. Now, when it comes to liability, let's go ahead and highlight that first sentence where it says when you owe someone else money, you could say that you are liable to that person or company. So if you see my definition again, it says current liabilities, debts that must be paid within 1 year. So remember, guys, I don't want you to figure out how to do a balance sheet. That is not what you guys are here to do. So when we go to page 22, this is an example of your balance sheet. Do not stress about making a balance sheet. You're not going to make a balance sheet for your business. You're going to hire someone to do that for you. Do not worry about this. What I want you to worry about is definition, terms, and examples. Definition, terms, and examples. So for example, current asset, definitely highlight that, right? On page 22, left-hand side, where it says current asset, that's the term. What's the definition of a current asset? Assets that must be converted into cash within 1 year. That's your definition. What are your examples of current assets? Cash, accounts receivable, retentions receivable, inventories, and prepaid expenses. Those are examples of your current assets. So again, the term, current asset. The definition, assets that will be converted into cash within 1 year. The examples, cash, accounts receivable, retentions receivable, inventories, and prepaid expenses. Knock that out already, right? Now, what about your long-term, non-current assets? Long-term assets are assets that will exceed 1 year. Term, long-term assets. Definition, assets that will exceed a year. And your examples. What are your examples? Buildings, equipment, vehicles, office equipment, less accumulated depreciation. These are your long-term assets. That's what I want you to focus on. Don't worry about making a balance sheet because you're going to lose time. Term, definition, and examples. Now, where it says current liabilities, that's the other term. Liabilities that will be due within a year. What's your example of that? Accounts payable, right? We already discussed what accounts payable is. Accounts payable is money you owe to your subcontractors and your suppliers. Taxes payable, current portion of long-term debt. So those are examples of your current liabilities. So very easily, we already knocked out the balance sheet. We already knocked out the most important parts of that portion, of this portion of the chapter. If you focus too much on trying to do a balance sheet, trying to make a balance sheet, you're wasting time. I need you guys to focus on your term, your definition, and your examples. Page 23, where it says working capital. Go ahead and highlight where it says working capital. Highlight that very first sentence where it says working capital, also referred to as operating capital, measures what is left over once you subtract your current liabilities from your current assets. Need you guys to remember that. Need you guys to highlight it. It represents your company's ability to meet immediate debts and obligations. So working capital is used to invest back in the business or into your next contract. What's really, really important here is the formula. When I took my state exam, I got a question in regards to the formula. Please, guys, remember the formula. I don't need you guys to know how to do it. I need you guys to remember what the formula is. So what is the formula? Total current assets minus total current liabilities. That will give you your working capital. So highlight the formula. In the last paragraph on page 23, go ahead and highlight that very first sentence, and you're also going to highlight the third sentence where it tells you, it is common for contractors to see wide fluctuations of working capital during a job. Why? In some cases, you might be investing your last couple $1,000s in a contract. So for example, let's say you get an opportunity for a $10,000 contract and you only have $12,000 in your bank account. So you invest the 10, which means you only have $2,000 in your bank account right now. What happens when expenses start to pile up and then payroll happens? What happens if your client says, hey, I'm gonna be late on the payment, can you give me at least 1 week or 2 weeks to pay you? You're gonna have to say yes, take the 1 week or the 2 weeks. But your employees cannot wait the 1 week or 2 weeks for payment. They can't do that. You have to pay them at least once every 2 weeks. So now you put yourself in a problem. You put your company in a problem because now you're gonna go into debt, right? The answer to this would have been opening a pre-established line of credit with the bank can help pay for these expenses until you receive payment for the work performed. Rule of thumb, guys, never submit a bid for a project you cannot finish by yourself, which means if the entire project costs $20,000 and you don't have $20,000 in your bank account, it is possible that sometimes clients will need an additional week or 2 weeks to pay you. Your employees cannot wait for payment. They have to be paid once every 2 weeks. Do not put yourself in a bind. Stack your chips, right? Stack your money little by little. Do little projects first. Get money in your corporate bank account. Get money in your company bank account. Have that cushion just in case something happens, because no one knows what will happen in the future. Once you start building up your reputation, once you start building up history with your company, then you can apply for credit cards. Line of credit, pre-established, which means prior to you getting into a problem, you have that line of credit you can use in the event that the client needs an additional week or 2 weeks to pay you. This is the problem when you don't have a license and you're spending 10, 20, 30 years working without a license because you have no history. All that time you could have been using to building up your company history, to building up your company's reputation is now lost. That's why it's important to get your license. That's why it's important to do smaller projects, build up your company's bank account to where you can finally approve for a bigger project, have those line of credits, credit cards, all under the company's name. Moving forward to page 25. Now on page 25, we're gonna be discussing a different form. It is called the income statement. Now on page 25, I do want you to highlight that very first paragraph in full. The income statement is a very simple, to me it's very simple. I think everyone can do an income statement from the top of their head. I'm gonna explain it now. I want you to highlight the very first paragraph in full. Let's go ahead and read it. The income statement is another important counting tool and is used to track sales and expenses during a particular period. It is sometimes called a profit and loss or P&L statement. Remember that. And it tells you if your business is profitable or not. So the main point of the income statement, did your company make money or lose money during a period of time? It shows you your income, revenues earned, cost of sales, and expenses incurred over a period of time, month, quarter, or year. The resulting difference between your income and expenses is called your net profit, often referred to as the bottom line. So what are some key takeaways from that paragraph? The income statement is also known as the profit and loss statement or the P&L statement. It shows you whether your business is profitable or not. And the bottom line of your income statement is net profit or net loss. Let's go ahead and go to page 26, and we're gonna get an example of your income statement. You can literally make an income statement for your personal life. What is your average salary a month minus your expenses? Is the last number a positive number or a negative number? If you're in a negative number, you're probably gonna go bankrupt because your expenses are outweighing your profit, okay? So for example, on page 26, the income of this company for the month of December was $200,000. What is the cost of sales? The cost of sales is the direct cost of a contract, which means they're not making any profit here. This is literally how much they spent to do their projects, okay? We're gonna discuss that in just a second. Expenses is their overhead. So I do want you guys to make a line from salaries to utilities. This is the overhead of the company. This is whether or not they have contracts. This is what they're paying for their overhead, company expenses, the cost of doing business. At the end of the month, the company was profitable $18,780. Here's the thing I need you guys to understand. This is apart from what the contractor made. This is apart from what the contractor made in salary, because the contractor pays themselves in the salaries portion in expenses. This is what the company made. So here's another mind switch, right? We're not employees anymore. We're gonna be employers. So if we're gonna be an employer, our company has to make money too. Why? Because a company should be investing in the materials. The company should be buying the trucks. The company should be buying the tools, the safety equipment, the workers' comp, the insurances. The company should be paying that, not the contractor. But this is where I need you guys to make that switch from employee to employer. And as soon as you make that switch, it's gonna get easier for you. Now, what is cost of sales? I need you guys to learn that, because in the next chapter, we're gonna discuss this again. The cost of sales, make a note, is the direct cost of your bid. So for example, what is direct labor? Direct labor is your payroll. How much money you're spending on employees. Direct labor. Labor burden, that is your payroll taxes. Materials used, very easy. The materials you used on the job. And other direct costs. What is other direct costs? Small fees, permits, bonds, site insurances. Very, very small, insignificant, miscellaneous fees, but you still, when added up, it still comes to a pretty good number. So the cost of sales is the cost of the project itself. Depending on the project, the price will change, right? So remember, there is no profit in the cost of sales. The cost of sales are expenses, but the contractor doesn't pay that directly. The client will pay that. And we're going to discuss that much more in chapter 6. So if you don't understand that, don't worry about it. We're going to discuss that much more in chapter 6. So on page 27, where it says direct labor, go ahead and highlight that first sentence where it tells you the direct labor figure compromises the actual cost for labor payroll for all jobs during the period covered by the statement. So labor cost. Where it says labor burden, highlight that first sentence where it tells you the direct labor burden item on the income statement includes all payroll taxes, insurance, and other employee benefits that are assessed against the labor period. On page 28, materials used, very simple. This is the cost of materials used on the job. Highlight that first sentence. And number 4, other direct costs. Go ahead and highlight that paragraph in full. This cost includes all items other than those listed above that are directly chargeable to individual jobs. So remember, depending on the job, that number will fluctuate. That number will change. All right, moving forward to page 32 and 33. On page 32 and 33, we're going to be discussing the ratios. Now, again, guys, I don't want you to focus too much on the formulas. I don't want you to try to do math and focus on how to figure out what the end number of the ratio is, because you're going to be wasting time. Term, definition. That's all I want you to focus on in regards to the ratio. So what is current ratio? The current ratio is used to measure liquidity, and it does provide your inventory value. It is used to measure liquidity, and it does provide your inventory value. What is liquidity? The power your company has to pay off debts immediately. What is liquidity? The power your company has to pay off debts immediately. And the quick ratio. The quick ratio is also known as the acid test. It is also used to measure liquidity, but it does not provide inventory value. And the reason for that, it's a more strict or more conservative way of measuring your company's liquidity. That's all I want you guys to focus on page 32 and page 33. Okay, moving forward to page 36. Now on page 36, in regards to budgets, it's kind of more like, let's say, common sense, but I still want you guys to highlight a couple things really quickly. On page 37 where it says respond to unexpected changes, use your budget to help you adjust to the unexpected. Basically, you're gonna set a monthly budget of expenses. So for example, if your budget is exactly $10,000, try not to exceed the $10,000. Stick close to your budget as best you can. But if there's unexpected costs that you need to cover, you're gonna have to go over your budget. And there's, like, for example, let's say your truck breaks down and you're already at that $10,000 mark. You need your truck to do work. So you're gonna have to spend more. Don't not spend just because you already met your budget. You're gonna have to spend more because you need your truck for work, right? So stick close to your budget as you can, but give it some breathing room in the event of unexpected cost, okay? I think that's pretty much everything. On page 35, the last paragraph, go ahead and highlight that first sentence where it says, once you set your budget, you should try to stay within it, basically what I just explained. But you also need to respond to changes in your business, such as unexpected expenses. That's pretty much what I just covered, right? Budgets are very simple to understand, but that's normally the question that you will get at the state in regards to budgets. So make sure you highlight that. So that is chapter 5, you guys. Thank you very much for your time. Please study this chapter as much as you can. And if you have any questions, please feel free to reach out to me or the directors at any of your schools. They are a team. We are all a team. So if you have any questions, please reach out to Anna, Max, Gerardo, Jose, Teresa, Omar, Aldo, Hillary. We're here to help you guys as best as you can. Study this chapter as much as you can. Repeat your classes in English and Spanish. And not only that, make sure you keep an eye out for your weekly exam on Thursdays. Please double check your spam folder. Sometimes they do go there, so I please need you guys to check your spam folder. And again, if you have any questions, please feel free to reach out. Thank you very much, you guys. Study up.